Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a moment, hit that subscribe button for all the latest content from us. A lot to talk about this week. I want to discuss the biggest story in markets this year, in my opinion. Imports plunging after a massive front running. We're going to talk about the latest trade data. Recession odds in the U.S. continue to fall. What a difference from where they were just 2 months ago. Don't expect a rate cut this month. Looking at the latest expectations, pricing in pretty much no chance at all that the Fed will cut rates when it meets in June. Labor market is loosening. We got a payroll report. We'll talk about that. A slow loosening in the labor market continues there. A little pain now versus a lot of pain later. This is really the trade-off that people have to make when thinking about the deficit. Do we want to continue to run big deficits, or do we want to try to do something about it today? The solution to the problem equals the cause of the problem. Another example of this that I want to highlight from the state of New York, and we'll end, as we always do, with something positive, and that would be strong wage growth once again in that non-farm payrolls report. Okay, let's start out with the biggest story in the markets this year. And you're probably thinking it's going to be something related to tariffs. But in my view, just looking at the data, forgetting about the tariff story, this is the biggest story in markets, the huge disparity between international equity markets and U.S. equity markets. Nobody had this on their list of predictions heading into 2025. And you can see in this chart here, international developed stocks, 17.9% gain. International overall, so everything outside of the U.S., so including emerging markets, 15.7%. You have emerging markets up 11.6%. And then you have the U.S. large cap S&P 500 index up 1.5%, and small caps still lagging by a good amount, down 7% so far this year. And if we look at the country picture here in terms of equity returns around the world, this is in US dollars, so all from a US investor's perspective, but just enormous returns coming out of Europe and the Eurozone. Top 6 countries in this list here: Greece, Poland, Spain, Austria, Germany, Italy, all coming out of Europe. Huge returns. Greece leading the way, up 43.8%. You can see the Eurozone ETF up 26%, and the Europe ETF 22.5%. And if we look at the US here, still in that bottom third of areas in the world, up 1.5% total return as of June 5th. Huge disparity. You rarely have seen this in going back the last 30, 40 years. Very rare to see this type of spread. We're now over 5 months into the year, so I went back and looked at rolling 5-month periods of MSCI World versus the US S&P 500. And just looking back, is anything comparable now? It's really only 2 periods I could find. This is the spread through 5 months, so through May. 15.6% outperformance for international stocks over U.S. stocks. You have to go back to 2009 to find a similar level of outperformance, and just a slightly higher in the early 2000s. We have 15.7%. So almost in unprecedented territory here. One of the big drivers for this has been the decline in the dollar. So things like the euro rallying and other currencies rallying against the dollar, that boosts your returns, or if you're coming from the US investing internationally. But it's not just that, it's gains on top of that as well. But here is that dollar index, 2025, worst return at this point in the year in at least 20 years. You got to go back a long time to find a worse return, down 9% through early June here in the US dollar index. So biggest story in markets this year, in my view, is this international outperformance. And the big question, of course, is will it continue? The last time we saw this big outperformance spike in 2009, it definitely did not continue. U.S. equities would go on to outperform by a huge margin going forward. But here, the question is have we reached an inflection point where we're going to start to see returns coming outside of the U.S. and pretty good start here to the year to try to make that case. So a lot of things factoring into this, but I think if you talked about the trade situation and you talked about that as a potential reason for global equities to do poorly at this point of the year, certainly not buying into that narrative here. And look at the country that the U.S. is slapping the highest tariff currently on would be China, and you can see China up 17%, so actually outperforming the MSCI World Index as it stands today. So fascinating developments in the equity markets. If you're thinking about your portfolio and you want a second look, reach out to us today at Creative Planning, creativeplanning.com/Charlie. Fill out this form, set up a call or a meeting with an advisor. We're in all 50 states at Creative Planning, so we likely have a location right near you. Over 350 billion in assets under management and advisement. So reach out to us today, creativeplanning.com/Charlie. We're here to help. Okay, number two here, I want to talk about the latest trade data. This was expected, but it came down even more than what people were expecting. Looking at the imports data, just a huge decline from the prior month. So we did 415 billion in the month of March, goes down to 351 billion in terms of imports of goods and services in April. That was the biggest decline that we've seen on record. But I think you have to step back and take some perspective here because there are a lot of headlines about this crash in imports. But if we look at where we were a year ago, it's still higher than we were in last April. So that to me is pretty incredible. And really, it's just a reversal of what we saw so far in the first 3 months of this year, which is a massive front running of that increase in tariffs. So companies in the U.S. clearly planning for these higher prices. They don't want to pay these higher prices, so they loaded up on inventory in January, February, and March of this year, pulling forward that demand, pulling forward those purchases. And then we see in April, when the tariffs are actually starting to take place, them pulling back. So if we look at the first 4 months of this year versus the first 4 months of last year, imports overall are still 18% higher than where they were a year ago. So if we're looking at predictions here for May, you would think, well, this would continue to be lower for the month of May to continue to normalize what went on in the first few months of the year. And I'd say the same in terms of the trade deficit here. You could see biggest move lower in the trade deficit in terms of monthly that we've ever seen. We went from negative 138 billion, which was a record trade deficit in the month of March, to negative 62 billion in the month of April. That decline in the trade deficit was the biggest on record. But again, if we look at the first 4 months of this year, we add up the trade deficit, it's 66% higher than the first 4 months of 2024. So still a ways to go to really make a dent in terms of what happened during that first quarter, which was simply a massive front running of the tariff situation. And if we look at the ISM for May, I guess if you're reading into this data, looking for a prediction for May, you would say that both imports and exports are going to be lower for the month of May. We saw the lowest reading for this ISM manufacturing import index since March 2009, so during the financial crisis, during a recession. So just a huge plunge there. And in exports, we saw the lowest level since May 2020 during the COVID crisis. So if we look at some of the respondents here, what you might expect in terms of what they're saying about the tariff situation: uncertainty, volatility, uncertainty, volatility, whiplash, chaos, back and forth. We know all of this. The question is how it's going to shake out at the end of the day. And that still remains unknown, but the markets are acting as if the end scenario is actually going to be just fine and positive. Now, if it's not, doesn't turn out to be that case, obviously you have downside risk for the markets. But right now, and we'll talk about the equity markets in a little bit in the US in terms of the reversal, right now the market's definitely not pricing in any sort of negative impact in terms of a hit to earnings. So let's talk about the recession odds here. and they continue to fall. And a big part of that is that reversal in terms of that import picture, because during the first quarter, we had that negative GDP print, and that was really all because of net exports. So, all because of that huge increase in the deficit. So, part of the GDP calculation is net exports. And when you have a huge trade deficit like we did in the first quarter, where imports just massively were massively higher than exports, well, that detracts from economic growth in terms of how they calculate GDP. So that was the major reason why GDP was slightly negative in the first quarter. And looking at the second quarter so far, we're looking at the Atlanta Fed. So they're feeding off of this data, this trade data, and they're saying, well, it's going to really bounce right back. They're saying 3.8% increase in GDP. And you can see their net export component, they're expecting a 2% contribution there. And they're expecting consumer spending to be quite strong as well. So we'll see the trend in this. Obviously, each and every month we'll get more trade data to really try to confirm this, but it seems like the most likely scenario is we're going to see a higher print in the second quarter, which of course lowers the odds of a first half recession, lowers the odds of that 2 negative consecutive quarters. And if we look at the poly market odds here of a recession in 2025, just plummeting down to 26% here as I'm talking on Friday. And that's down from 66% if we look at early May. So it wasn't that long ago when market participants were saying pretty high percent chance that there's going to be a recession this year. And now back to, I'd say, a relatively low chance. If you have a recession, let's say once every 5 years on average historically, well, the odds at any given time should be about 20%. So we're at 26% chance right now. The markets obviously are reflecting this. You could see the equity markets gain now 24% off of the lows for the S&P 500. As I've talked about, this is one of the biggest short-term market comebacks in history. The other dates on that list would be March 2009, March 2020, 1982 at the lows, and 1974 at the lows. This is right there with those types of comebacks. And we're not that far. We're at over 6,000 now in the S&P 500, not that far from erasing that entire bear market here, which would be one of the quickest comebacks in terms of getting out of a bear market that we've ever seen. So just an enormous rally. And you could say it's kind of circular. Odds of recession going down because the market's going up, or the market's going up because the recession odds are going down. But any way you look at it, very different picture than what investors were pricing in early April, which is essentially the tariff, if they were left in place, was going to push the U.S. economy into a recession and be a big hit to earnings. Now market participants saying essentially we're back to square one here and not pricing in much of a negative impact at all, I would say. Okay, let's talk about the rate cuts. Don't expect one is my message. If you're thinking about a rate cut at the June meeting, June 18th is the next Fed meeting. I don't think it's coming. And I don't think so for a number of reasons. But number one, as we get closer to that meeting, we know what the Fed has done in every single meeting since the beginning of 2009. They've done exactly what the market was expecting it to do coming into the meeting. So now we have 99.9% chance that the Fed does nothing at that meeting, and just a 0.1% chance that there may even hike rates, which of course I don't think is going to happen. So pretty much if this stays anywhere near this, I don't think the Fed does anything. And if you listen to the last Fed press conference, it seemed pretty clear that Powell is comfortable staying where he is, staying at 4.25 to 4.5%. in a wait and see mode to see what happens with the tariff situation. And obviously, we've got some more clarity since that last Fed meeting, but still very much uncertain in terms of, is there going to be an impact in terms of inflation? Is there going to be an impact in terms of growth? That doesn't happen immediately. That will take time to see it in the data. And if you listen to Powell's comments, it seems like he's happy to wait and see right now, very comfortable to do that. And the market is essentially pricing in now no cuts until the fall. So similar to last year, where people were expecting rate cuts early in the year. It didn't happen, got pushed back, kept getting pushed back. Now the markets are saying, once again, the Fed's going to cut rates starting here. They're saying in September, and they're going to do a 25 basis point cut then, and then one more at the last meeting of the year in December. And that would just bring the Fed funds rate down to 3.75 to 4% if that projection is correct. But as I always say, a lot can happen between now and then. We're going to get a lot of data on the economy, on inflation, and all of these expectations could very well change. But in terms of why the Fed isn't going to move in June, well, let's start with inflation and look at their preferred measure of inflation, which is the core PCE data here, which excludes food and energy. And what you can see here is there's been a nice trend downward here in terms of where we hit the peak in September 2022 at 5.6%. We're down to 2.5%. That's the lowest since March 2021. But the Fed's target, let's remember, is 2% inflation. So we're still above their target. We still haven't gotten there. And we still have this built up excess inflation that occurred over the past few years. So I think the Fed wants to be sure before they continue cutting rates that this is really headed back down to their 2% target. And what I've been saying is even if we get to that target, that doesn't erase the prior inflation. And we still have, looking at CPI, more than double the Fed's target in terms of the annualized inflation that we've seen since January 2020. So the prudent thing in my mind would be to close some of this gap before you start thinking about an easing cycle, particularly with the labor market still holding up pretty well. So the other side of the Fed's mandate is the employment side. And if you look at the unemployment rate, we got another non-farm payroll report today, still doing okay. So still at 4.2%, holding there for the last few months, well below the historical average, which is about 5.7%. And if we look at the payroll streak here, another positive month for payroll. Payrolls here, 139 jobs added for the month of May. That was a little bit above expectations. And this is the 53rd consecutive month of jobs growth in the U.S., which is the second longest streak in history. But if we're looking at the labor market and we're thinking about, well, what would cause the Fed to start cutting rates regardless of what's going on in terms of inflation? Let's say inflation stays, let's say 2.5% to 3% in terms of core PCE between now and the end of the year. What would cause them to cut rates even if it doesn't get down to 2%? I think you would need to see further weakness in the labor market in terms of loosening here. And we're seeing it. It's just been gradual so far. So if we're looking at the growth in payrolls over the last year, so any 1 month, a lot can happen, and there's revisions, and there were revisions again this year. So I like to look more at this year-over-year change in terms of payrolls to give you an indication of what direction you're going in. And now we're seeing 1.1% growth in terms of the total jobs in the U.S. over the past year, and that's the slowest growth rate that we've seen since March 2021. So clearly, labor market is slowing. The historical average for this reading here is about 2% year-over-year increases. So definitely slower growth. And in terms of looking at the payroll data, the best real-time indicator you can look at is simply looking at jobless claims. So how many people are filing for unemployment insurance? And I like to look at continued claims, so the people that are staying on insurance. So it's not just they were laid off and then they found a job a few weeks later. These are people that are staying on it here, and looking at a 4-week moving average of this continued claims data, you could see it's creeping up here at I would say a slow pace. It's definitely not something alarming, but this is certainly something I think the Fed is going to be paying attention to if we start to see this really start to trend higher. So if you're making the case the Fed should start cutting rates before that September meeting, you're probably making the case that the labor market's going to be showing some significant signs of weakness. And right now, I just don't think we have enough data in the way of that to say that. So watch this indicator pretty closely here. And also, of course, we're going to get more inflation data next week in terms of the CPI report, dig into that as well. But in terms of everything Powell's saying, it seems pretty clear he's not going to be pressured into cutting interest rates until he thinks it's the right time in terms of that balance between inflation and employment. So I want to talk now about the budget deficit in the US and really answer the question of why we're not tackling this deficit, why we're not being serious about it. And it's essentially, in my view, a trade-off between today and the future, where you could take a little pain now in reducing that deficit, or you could take a lot of pain later by not doing anything about it. And essentially, if the bill stands the way it does now, that big, beautiful bill, which I don't think is very beautiful because of what it's doing in terms of the deficit. Well, if it stands the way it is now, you're essentially saying that you don't want to take any pain now and you're willing to accept a lot of pain later. And the unfortunate thing is that there was a lot of support for it. If there was ever a time where you could actually make a dent in terms of the deficit, you could put the country on the right track again in terms of moving more towards a responsible budget, it would be today, because entering the year, this was the polling in terms of U.S. voters. 2/3 were saying that the U.S. federal government debt is unsustainable. And if you ask them, should we move towards a balanced budget or should we continue to run significant deficits, over 80% said we should try to move towards a balanced budget. And that's why it's so unfortunate. We'll see how the bill shakes out. It's unfortunate if they're not capitalizing on this moment to try to reduce this deficit. So we're at $2 trillion. We're spending $7 trillion. We're taking $5 trillion in terms of tax revenue. And if this bill passes as is, if the Senate doesn't make significant changes, and there are a few senators that are trying to do just that, but I don't know if it will be enough. We'll have to wait and see. But if it stays the way it is, we're going to add to that deficit most likely in the coming years. And I know a lot of people argue about the estimates and the numbers, but I don't hear anyone making a credible case, let's say, that this is actually going to reduce the deficit. So what is it actually going to do in terms of deficit numbers? We don't really know the exact numbers, but no one's making a credible case that we're not going to continue to at least run $2 trillion deficits going forward. And I think there's a higher than equal chance, if the bill stays the way it is, that the deficits will actually increase. So what you have to do, I think, is two things here. What I'm calling for, number one, yes, you can extend the tax cuts from 2017. I don't think we need to see a tax increase. I've made the case that it's much more of a spending problem. If you just look at the increase in spending over the last decade, 95% increase, tax revenue's gone up 60% over that period of time. So we have much more tax revenue coming in. We don't need tax increases, in my opinion, but we don't need to now, if we have a deficit problem, throw on all of these additional tax cuts as well. Let's first cut the deficit, get it back to a good position. And once we are in a good position, then we can talk about additional tax cuts. And on the spending level, you could just see what we've done in the 2020 so far is just an aberration. We've spent so much more as a percentage of GDP than we have looking back at history. You can see back in the 1950s and 1960s, we're spending 17, 18% of GDP. Even in 2000s, we're at 20%. We bumped that up to 23% in the 2010s. And here we are in 2020s running at 27% so far of GDP. So it's an unsustainable spending level. You either cut it now and take the pain, and there will be some perhaps short-term pain. We can debate that. If you cut that spending, obviously someone's going to feel it somewhere, maybe even be a hit short-term to the economy. But you either cut a little bit today and take that short-term pain, or you're going to have to cut a lot tomorrow. And the reason for that is because when you continue to add to the deficit, when you continue to add to the national debt, interest rates, as we've talked about, are going to stay higher most likely than they have in the past. And that causes this situation where you have it's much harder to pay back that debt. So if we're looking at the interest on the national debt, you could see the huge increase over the last few years as interest rates have risen and as we've added on a significant amount of debt. And now we're spending more on interest than we are on national defense. So if you want to get this number under control, you can't allow that debt number to increase the way it's likely to increase if we continue spending the way we are. So we'll see what ends up happening. But if the bill is passed as is, and we're looking at $2 trillion deficits for years to come, the reason for that is going to be that trade-off that the politicians are making, essentially saying, we don't want to take any short-term pain, even if it means a crisis down the road. We're going to wait for that crisis in order to act. And I think it's unfortunate that's the case because the American people don't want the debt, but they're going to end up paying for the debt down the road. And this is an avoidable situation. We just have to make some tough decisions today. So hopefully people will step up. There'll be leadership to say, we can't continue to do this. Our kids and our grandkids, we can't give them this debt to pay back in the future. We can't wait until it's a crisis before we address that. I hope that's the case, and I hope that's what I'll be talking about in the weeks to come. Interesting situation where you have the solution to the problem being the cause of the problem. So the cause of inflation, a lot of people have debated this, but in my view, pretty much indisputable. It's a monetary phenomenon, and it's a function of deficit spending. So if you look at the federal government, what they did in terms of 2020, 2021, the huge, enormous stimulus bills, essentially borrowing from the future to spend money today, that was the primary cause of the inflationary spiral that we saw. And then you had a number of states essentially saying inflation's very high, so we need to do something about it. And their best solution was the cause of the problem. So their best solution, California has done it a few times and now New York's trying it as well, is to essentially say, let's send out, they're calling it refund checks to residents. They're $150 to $400, not a huge amount of money, but I think it's more the principle of this thing. They're saying it's designed to provide relief from rising inflation. But if you do this at a massive scale, of course, it's only going to increase inflation once more. So if you think about it, you're borrowing money, you're sending it out to people. What are they going to do with that money? Part of that money they're going to save, part of that money maybe they're going to invest, but part of that money they're going to spend, and that will create more demand for the same amount of goods, and so that's going to drive up prices. So it's going to not help with inflation. It will further cause inflation to be a problem. And I'm not suggesting that New York by itself doing this stimulus is going to have an impact, but let's say if we did this again as a nation, every state did it, or you take this to the extreme and you say, let's do thousands instead of 150 to 400, what's going to cause problem? All else equal, if you're borrowing money and you're sending it out to people, you're essentially adding to the money that's out there, and you're creating the situation where there's too much money chasing too few goods, and that's what drives prices up higher. And if New York State had a budget surplus, if they had a lot of money just sitting around, they wanted to issue this type of refund, or you could call it perhaps, I wouldn't be very opposed to that, but that's not the situation. Like the national debt, the U.S., New York State's debt has been going up and up and up. In 2000, it was 78 billion. Now it's 180 billion, and that doesn't include these massive unfunded pension liabilities. In 2022, there was an estimate that would bring it up to 245 billion in terms of total liabilities if you include these things. So New York State not doing anything different, I guess, than the federal government, but it's interesting to say that they're doing it to solve inflation, to help with inflation, when it was actually the cause of the inflation in the first place. So I want to end, as we always do, with something positive, and that would be strong wage growth in the U.S. We got the best number in the non-farm payroll report would be the average hourly earnings increase over the last year, 3.9% increase, still very strong. looking at the historical average here around 3%, so better than that. And really, what you have to compare this to is how much prices are going up. And so, if we look at the inflation data over the past year, we look at the projection for that May CPI report that we're going to get next week, 2.4%. So that's a nice spread of about 1.5% between the increase in people's wages and the increase in prices. And if you compound that over time, it makes a meaningful difference, of course, for people's wages to be going up more than the rate of inflation. They have more money to save, to spend, to invest. And I think this is part of the reason we're seeing 401k contribution rates continue to increase. This was a data point out of Fidelity that recently the average savings rate moved up to 14.3%, which was a record high according to their data. So we'll end it right there. Thanks everyone for joining me. Have a great weekend. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Week in Charts.